In this video, I'm going to talk a little bit about why the stock market is going so high right now. And this has been a big point of discussion in the financial media, in the news media, because there's been such a big difference between what I'll call the Main Street economy and the Wall Street economy. And you see this decoupling between the two, which means that they kind of feel like they're not really related to each other anymore. And that's sort of what's going on. And so I was going to talk a little bit about a few of the factors that are leading to this decoupling. So the Main Street economy and the Wall Street economy are driven by separate factors. The Main Street economy is driven by, like foot traffic, travel, and gatherings, and just based on people being out and about. And obviously that's not happening right now. And so these businesses are really struggling. They're demand-based businesses. And you see a lot of like restaurants and retail stores having to shut down or fire employees to save money. That's a lot different than what's going on in the stock market right now. The stock market is racing to new highs pretty much every week. And the stock market is a little bit different than the Main Street economy because it's driven a lot more by technology, by the really big businesses, which are mostly technology. And it's also driven by politics. It's driven by macroeconomics. And so those differences are really clear, especially in this kind of a situation where there is no foot traffic, there's nobody out and about. That's really suppressing the Main Street economy. And technology is a must because we're all sitting in our houses, not going out, and we're having to figure out how to keep going with our lives and stay productive and communicate with others without going out and leaving our house. And so that calls for a lot of technology, a lot of innovation, and that's where the investment is going right now, and you see that reflect in stock prices. So the first factor I want to talk about is interest rates. Interest rates are extremely low right now. The U.S. government bond 30-year is right around 1%. So that's not a great investment. You have all these big institutions that control most of the money. They have to get a certain level of return, let's say like 5 or 6% a year, to pay out whoever they need to pay out to, whether it's an insurance company or a university endowment fund. They need to pay out a certain amount of money without cutting into their principal. So they're investing in the stock market because there's not really anywhere else to invest their money. And so with interest rates being so low, and by the way, when I say interest rates, I mean the Federal Reserve sets the interest rates as to the rate that they want to lend money to other banks. And so they set the interest rates low so that there's more easier access to money overall in the economy, and that really stimulates the economy. And so they've been cutting rates since we had the coronavirus set in, so that we could have a lot more liquidity in the market. And when interest rates are this low, bond yields really go down. So there's $18 trillion in the world in negative yielding debt, which means that your investment would be getting -1%, -2% per year. And so that's not a very good, very appealing way to use your money. And these big institutions have to find somewhere to get some return. And so basically the only place they can go to is the stock market because there's no yield anywhere else. And so with interest rates being this low, money is basically free. Money is very easy to get, and it's very cheap to get. And so it's a lot easier to borrow, to invest, and that kind of thing. And we also have the expectation that interest rates are going to be low through 2022. And so with that kind of a time horizon for low rates, that really gives us investors a lot of confidence to really pay a high price for stocks and to just spend money in general. So you have all this money from these institutions, these financial institutions, just really flooding into the stock market, and that's just inflating the stock market really high. The second factor I want to talk about is just how much money is being printed right now. You can see this chart of the M2 money supply, and you see the really smooth curve since the 80s and 70s, and then you see this enormous spike in 2020, and that spike occurred in March when the coronavirus started. And so you see that huge spike from the Federal Reserve printing tons and tons of money earlier this year, basically to send out in stimulus checks and to continue providing liquidity into the market. In fact, there's been a 23% increase in the money supply since March, which is pretty incredible. So just in theory, that would push up the stock prices 23% higher if there's 23% more money, everything else being equal. And right now we're currently about 16 or 17% higher than the February high. So basically, when there's more money to spend, there's more money to invest, and stocks go higher. The next factor I want to talk about is the acceleration of technology. So basically, we're all sitting at our house, but we still need to get things done. We still need to be productive. We still need to communicate with people. So we had this necessity for innovation, for software and other kinds of technology that help us do this basically without leaving our house. And so companies like Zoom and like Microsoft and Slack were really set up for this. They were really software and technology driven. And so that just helped them, that helped their user traffic, and their stock prices followed by going up. But there's a lot of other industries that have really been harmed, and all the money from those industries like retail, oil, hotels, travel, banks, none of these industries are really appealing to invest in right now. So a lot of that money that was sitting in those industries is being pulled out and really just being invested into technology, and a lot of these companies that are really set up to deal with the pandemic as it is right now. And so like you can't invest in an oil company right now because there's just no demand for oil, and the electric vehicle companies might have damaged oil demand forever. You can't really invest in banks because interest rates are so low that the loan deposit spreads are shrinking. That's one of the only ways that the bank has to make money. So you can't confidently put your money there, invest it anyway. There's just no traffic in hotels and travel and retail, and we don't know when that's going to start occurring again. So basically, again, all this money from these beaten down industries is just being flooded into mostly technology. And so the last factor I wanted to talk about was this huge inflow of retail investors. And when I say retail investors, I just mean any individual who basically handles their own money and handles their own investments. So the reason we're seeing a huge boom in retail investor activity is because of all these investing apps with low fees or zero fees, and they're incredibly easy to use. They're really convenient, and that just makes it really easy for anyone, anywhere with a few dollars in a bank account to get set up really quickly and start investing in the stock market. And a lot of these retail investors are kind of the new generation of investors. They're younger people, and so this new generation favors technology a lot more. They understand technology, and they're willing to pay higher prices for growth and for future earnings because their risk tolerance and their time horizon is a little bit higher and a little bit longer for the time of their investment. And so a lot of this retail investor money is really going into these technology companies. You see these technology companies starting to have really high price to sales and price to earnings multiples because there are so many new investors willing to pay a higher price and a higher multiple for that future growth. And another thing driving this activity is the fact that people are working from home, and the stock market is only open during the day, like during business hours. And so people have a lot more time to, buy and sell stocks, whether it's on their lunch break or whenever. They're at home, they don't have their boss like looking over their shoulder, and they can just buy and sell stock basically whenever they want to because the market's open and they're at home. And so a few other factors that are pushing the stock market higher. First of all, let me say, when you're thinking about the stock market, remember that the stock market factors in everything that we expect and everything in the future that we already think is going to happen. And so it's not just as simple as looking backwards and looking in the present. You have to look into the future and what people are expecting, and that's what the stock market outlook is, and that's what is being priced in. So again, the stock market is all about the future, and in this case, we expect a really smooth vaccine rollout, and we expect lots and lots of people to be vaccinated by spring and summer of 2021. And so we think that'll go smooth, and that'll drive people to travel more and to go to retail, go to restaurants and movie theaters and all that kind of stuff. And that'll help out more of the Main Street economy, like I was saying earlier. We also have this expectation of pent-up demand where, as soon as somebody gets vaccinated or even just warmer weather, we'll see those people go out and travel, get on an airplane or a road trip or do something like that, because it's been a long time since we've been able to do that, and all that demand is starting to pile up, and we're really kind of getting cabin fever. We want to go out and do stuff and buy stuff and be at concerts and sporting events and everything like that. That is going to start being realized in kind of the spring and summer. Another positive factor is that the election is over. Not necessarily of who won and lost, but just that it's over and we have some certainty now for the next 4 years. And so that certainty gives us a little more confidence in what's going to happen and where we can put our money, knowing that things aren't going to dramatically change one way or the other for the next few years. Another thing really pushing stocks higher is that Tesla was added to the S&P 500. And so Tesla is one of the fastest growing, most technologically advanced businesses that we've ever seen. And when you add it to the S&P 500, it's already like one of the 5 or 6 biggest companies in the S&P 500. And you see all these index funds basically force buying it and forcing it higher and higher and higher. And with Tesla being such a big company, when Tesla stock price goes up, that usually means the rest of the stock market goes up. So you may only care about, is the stock market going to go up or down from this point? Well, I don't really know that, and I don't think anybody else does either. But you just have to consider the factors that I mentioned, as well as some of the others that I may have missed. If any of these factors change dramatically, that could dramatically change the stock market. If the government stops printing money, if they stop with all the stimulus, that could send the market a little bit lower. If the vaccine rollout doesn't go as smoothly as we think it's going to, and we continue into the summer and fall kind of being locked down, that may suppress the stock market a little bit. If interest rates go higher, that could really suppress the stock market, I think, more than anything. And again, it's all about future expectations. So if something is dramatically different than what we currently expect to happen, that's how the stock market moves. The stock market could go higher if we continue with stimulus, if the vaccine goes better than planned and people really start getting out and about earlier than we expected, if quarterly earnings reports turn out to be really good, and we have this confirmation that these businesses are doing really well and earning a lot of money. It just it validates a lot of these high prices and validates our investments. So just consider those factors and what we currently expect, and you can kind of know where the stock market is going to go, whether or not those expectations change dramatically. I hope you enjoyed this video. If you did, click the thumbs up button below and leave a comment as to what factors you think are affecting the stock market that I left out. Also subscribe, because that really helps me out, and I'll be putting out more content like this. Thanks.